Welcome to Real Estate Radio Live, an informative and engaging podcast discussing everything you need to know about the world of real estate. Your host, Joe Cucchiara, provides you with insight and guidance on how to buy, sell, finance, and invest in real estate. He also offers real estate tax management strategies, new construction advice, home improvement tips, and much, much more. And now, to guide you around the world of real estate, here's your host and Real Estate Radio Live team leader, Joe Cucchiara.
Welcome in, Joe Cucchiara with Real Estate Radio Live. Thank you for all those that continue to tune in to the show. I appreciate that very much. We are wrapping up 2020 like a lot of people in an odd, kind of crazy, strange year. And before I get into the show today, I just want to thank everyone for continuing to follow the show and give us feedback on a regular basis. We appreciate that very much, and we certainly hope that all your friends, family, and loved ones are safe and healthy and ready to go for 2021. It's been quite a year. So this podcast, what I'm going to do is wrap up 2020 with a review. I'm going to do a review of 2020 real estate, and then I'm going to get into some projections and kind of a look at real estate for 2021. I'll touch a little bit on commercial as well. I don't have any commercial expert or specialists on the show today, but we do know enough about commercial real estate and kind of an idea of the insights of what's going on with that. So we're going to talk a little bit about a review in 2020, what happened in real estate and lending, and then a quick look at what our projections are and what we think is going to continue to happen. And what we think the outlook is going to be for real estate in 2021. Again, I want to thank all those that continue to follow the show. For almost 11 years now, we have been doing live radio and podcast, over 1,700 interviews and shows, and we're proud of that. We continue to try to bring as much information as we can to the community as possible. This year has been a tough year. We haven't done as many podcasts as we'd like to, and we haven't had as many expert guests on as we'd like to, just because it's been an odd year for a lot of people, and some have stayed off a lot of the different podcasting, and a lot of people have moved away from doing some of these shows for a period of time. So anyway, quick review of 2020 in terms of real estate. So residential real estate has stayed pretty strong. Most people know, you've been following a lot of the news, not only our podcast, but a lot of news that's taking place throughout the different sectors and different areas of the United States. Specifically, just to remind those, we broadcast in Silicon Valley, so most of the focus of what we discuss and talk about and share is related to the Silicon Valley and the Bay Area. However, we do have thousands of listeners. We have 10,000+ downloads a month. A lot of people follow the show, listen to the show that are in other parts of California and other parts of the United States and outside of the United States as well. So we thank those people for following us. But the majority of the content and information we share typically really encompasses the Silicon Valley and real estate around the Silicon Valley. So if we specifically discuss any other states, we'll talk about that. So most of what's taken place in the Silicon Valley and the greater Bay Area this year has been steady growth. I think most people would be surprised when this pandemic hit. Most of us, including myself, was not sure how this was going to affect real estate. I really wasn't. I follow real estate. I have for 20 years, and I've done this show for 11 years. So our job is to really study real estate on a regular basis and gather data and share that data when we can, and anything that may be changing to the marketplace and how it affects consumers. So I was one that was not sure exactly how real estate was going to handle this pandemic. And as it unfolded, we saw that real estate actually benefited. And I'm going to share a few things, the reason why I think real estate has benefited. Number one, in the Silicon Valley, inventory has stayed fairly low. So there was not a whole lot of inventory on the marketplace to begin with. Number two, and one of the single biggest reasons I still think, is the cost of money. Mortgage interest rates are at historic all-time lows. You could get 30-year money for below 3%. That's unheard of, certainly in the last 40 or 50 years in the mortgage market. So that's one of the primary reasons as well. that real estate has stayed strong. A lot of people are taking advantage of not only refinancing and saving money on their real estate on a long-term approach, but a lot of people are taking advantage of the purchase market and the low cost of money. And so that's one of the main drivers as well. There's a few other things that have played into the real estate market that are unique and do have something to do with the pandemic. And I believe that these few things helped fuel the real estate market as well. One is the whole stay-at-home order. Let's face it, on and off since March, back and forth, we've had stay-at-home orders, we've had lockdowns, we've had businesses make adjustments, we've had a lot of things take place. Well, one of the things that people are doing, obviously, is staying home more. What does that mean? Other than staying home more, people are now reassessing when and where they could work and what kind of flexibility they have to work. So I'll give you some examples. We're seeing a lot of activity this year in people buying second homes. And if you live in Silicon Valley, we're seeing a lot of people purchasing in, let's call them, vacation spots or second home locations. And I'll give you some examples: Lake Tahoe, Santa Cruz, Monterey, Carmel, Pebble Beach, places like that. We're seeing a lot of activity, people buying in the mountains, people buying in places where they want to try to get away and spend some time. And they're realizing that even during this pandemic going forward, there's a highly likely chance that a lot of people will be able to continue spending a fair amount of their time from home and even working from home, depending on, obviously depending on what the structure is and what the mandate is and what the policies and procedures are in and around those specific corporations and companies you may work for. But certainly high tech, the spotlight has been on high tech in the sense that most everybody now is realizing that, in a perfect world, it'd be great to go into an office. In a perfect world, it'd be great to have one-on-one meetings. In a perfect world, it'd be great to get on an airplane and go seal that deal and meet with certain people at companies, shake their hands, have eye-to-eye contact. That isn't a perfect world. The perfect world has been put aside and put on the back burner this year. So what it's done is brought to the forefront the other forms of communication and the ways that we conduct business when we have to. Most people have been forced to now say, okay, well, I can't keep that meeting in person. I can't take that flight now. It makes no sense for me to have a convention. It makes no sense for me to have a board meeting. There's a lot of different things that have taken place. So this may be obvious to some, but we want to share this information. I also think this is a big reason why real estate has stayed strong, and I think it will stay strong. We've seen run-ups in prices, and you hear some skeptics and some people, rightfully so, concerned about the run-up in appreciation in home values. I understand it, but what I would say is I'd caution people against is try not to compare, I should say. Try not to compare 2008, 2009 to the run-up in values at this current time. There's no comparison. There's zero comparison. The only comparison is that we've had a huge run-up. There was no other comparisons. And what I mean by that is back then in 2008 and 9, when we had the mortgage meltdown and the real estate crash, as we look back, there was obvious reasons why that took place. People were borrowing money that never should have borrowed money. People were purchasing homes with nothing down. See, when you have no skin in the game, and you shouldn't be buying a house to begin with, those are two really scary propositions. So you had millions of people, A, buying homes that they technically could afford, and B, in many cases, buying homes with no money down. Well, what do you think happens to that sector of the economy or people when the homes go underwater or when they get in trouble? Think about it. It's easy to walk away from real estate when you don't have any skin in the game. If you got $1 million home and put nothing down and you got into trouble, I'm not saying someone wants to do it. I'm not suggesting that there's a reason one way or another, but let's face the facts. The facts are, if you get into an investment, in this case, real estate, and you put nothing down and you get into trouble, it is a lot easier to walk away from that property than if you had to put 20% down and you had to qualify for that loan. Believe me, I've been in this market for over 20 years. You buy a home for $1 million with nothing down and you get into trouble, you're going to walk away. You buy a home for $1 million and you put 20% down, and now you have 20% equity stake in that. Regardless of whatever could happen, there's a likelihood, there's a better chance that you will sell that home or try to negotiate to keep that home or do something because you have an investment now in that property. So don't compare what's happening now to back to 2008 and 2009. That was millions of people that never should have bought homes, and they got into trouble, and that just snowballed, and we know what happened from there. So the difference now is this pandemic has shed the light, and again, I'll say it again, put the spotlight on all of us and said, how do we conduct business now? Okay, well, we're going to have to make adjustments. Now everybody has almost 12 months of adjustments. And guess what? A lot of companies, a lot of businesses, a lot of individuals are looking at their business. I don't care what size it is. I don't care if it's a 2-person business or a 15,000 or 20,000 business or plus. They're looking at their businesses and talking about how the business is going to look in the future. And this is what the pandemic has done. More people staying at home, more people focused about that, more people realizing they could work from their home. So this has had an effect on real estate. The other thing I would say that with people staying at home more is had people have second thoughts about reinvesting in their own investment. Let me elaborate a little bit on that. So you have a home that you've lived in for a while and you enjoy that home. And now you're realizing you're going to be spending more time at home. And now you're realizing that you might have an office at home. And now you're realizing that your business life could change now and the home could be part of that equation. Now what we're seeing is a lot of people taking money out and or reinvesting back into their property and expanding, adding offices, adding additional rooms. We're also seeing people spend a lot of money on landscaping, backyards, outdoor kitchens, a lot of things of that nature that are taking place right now because most people believe that even when this pandemic subsides and it's safe to come out again, that there's going to be even more activity still at home. So because of these are some of the reasons why I think real estate is still thriving, and I do think that real estate's a great investment right now. You know, when a lot of investors get concerned, when the market gets concerned, when the economy gets concerned, usually what happens is it's a flight to safety or away from risk. So for instance, you know, when there's concern in the marketplace, the economy starts looking shaky or maybe job markets aren't coming in good, a lot of the money really moves in from more aggressive, into more conservative investments like bonds and different things like that, which help the mortgage rates. Well, the dynamic right now is the mortgage rates are super low and the market has done quite well. So the last thing I'll say about the reason why I think real estate has stayed strong and it will stay strong is the things I just mentioned, and I'll go through them real quickly again, is because it's a flight to safety to a certain extent for people. It's a diversification in investments. And let me elaborate on that. See, when people get nervous about the market and about investments or gold or stocks or bonds or different things, guess what they do, especially this day and age? They invest in real estate. They take some money off the table, they take some money out of the market, and they invest in real estate. This is another reason why real estate has been strong and real estate will continue to be strong. There are some areas that I'm going to talk about where real estate's not going to be so strong, and I'll discuss that in just a couple minutes. But let me just finish this. So let me just wrap this up, this section, to really a review of 2020. Real estate stayed strong. It continues to be strong. And now I'll talk a little bit about 2021. And the reasons real quick, I'll just summarize real quickly, is because Rates were at all-time lows. Cost of money's cheap. That drove the market. Low inventory also drove the market. What else drove the market was this pandemic and people spending more time at home, people realizing that they were going to have offices at home, companies realizing they didn't need people being in the office. For these reasons, real estate has stayed strong. Now, what I want to talk a little bit about before I get into 2021 and a little bit about commercial is I'm going to share with you what I strongly believe the areas of real estate which will stagnate and suffer in the short term and maybe in the next couple of years. And those are the following. I think you should be concerned about any downtown city living, any downtown high-rise living. What I mean by that is any major cities, I don't care if it's downtown San Jose, San Francisco, New York, those places are going to be vulnerable right now. Those places I would stay away from, and I would keep an eye on that. And here are the reasons why. The pandemic has brought to the forefront the idea of crowded locations and people coming in and out and going in and out of elevators is a huge concern. So if you look at high-rise buildings, apartments, condos, those types of things in the hustle and bustle cities, those are becoming less desirable. You're going to see, I don't know about significant, but you're going to see some price declines in downtown living in most major downtown cities. And when I say major, I can't speak to downtown St. Louis or Chicago or Cleveland and places like that. I'm talking about in the Bay Area, downtown San Jose, downtown San Francisco. I think you're going to see some significant downturns in value and desirability in those locations. Remember just a couple of years ago when everybody said downtowns are going to be booming because everybody wants to get in the elevator, walk their dog to the store, walk their dog to the restaurant, do whatever you do. Everything's walkability, right? That's all changed. It's all changed. I don't know if it'll change long term, but it has changed temporarily. What I mean by that is there are no longer are there people rushing to downtown cities to be in high density areas to be expose themselves to COVID-19. And that's a concern for people and businesses, not just individuals, for businesses. So the real estate that I would be very careful and cautious is the following. I would be careful and cautious of downtown high density areas, high rise apartments or condos, and also commercial. We've done several shows on commercial. We've done over the last couple of months. If you're following the show, you're listening to them. Commercial is really interesting right now. And the reason I say that is I don't care how much enthusiasm you have for the Silicon Valley and people raising their flags saying no matter what, Silicon Valley is going to be strong. I agree with part of that. I think, in general, Americans are strong, they're resilient, they're vibrant, they'll come back, we'll all come back strong. But there will be some temporary setbacks. And I do think commercial, there is a temporary setback taking place here. You could deny it, but if you look at the data and you see what's going on, there's some real concerns. You have major companies exiting Silicon Valley in the Bay Area, not just here, but all over. Let's speak to this. We've had Oracle, HP, Tesla, there's several more. I could go on and on. These are huge names affecting the exodus of the Bay Area with commercial real estate. Now, some people would say, well, Joe, that's a drop in the bucket. That is true. It's a drop in the bucket temporarily, but you wait and see. Don't kid yourself. There are CEOs and executives all over keeping a close eye on this. I think will be interesting to see, and it could be that they're just too big here, but if you see or you hear rumblings of a company like Apple or maybe Google or Facebook, if you hear the rumblings about one of those three or a few of those three considering moving or transitioning out of the Bay Area over a period of time, watch out, because those are big, big, big deals. Facebook, Google, and Apple. If they decide to start transitioning out of California and out of the Bay Area, that is a big signal. And let me tell you, that will affect real estate and commercial real estate in a big way. Now, some of you may be saying, Joe, come on. I mean, I know they're big, but believe me, do the research. I have done the research. You would not believe how much real estate those three companies own and operate and lease in the greater Bay Area. Do me a favor, get a chance, go search it. Find out how much square foot space, either leased or owned or combination of, that Apple, Google, and Facebook represent and have here in the Silicon Valley and basically the greater Bay Area. It would blow your mind. Let me tell you that. Millions and millions and millions of square foot that they own or lease or operate here in the Bay Area. So when you see one of those potentially saying, we're going to consider moving operations, corporate, whatever it be, to another state, watch out. That could have a significant effect. So I would keep an eye on that. Regardless of those three big companies making a decision, you're still going to see a weakness in commercial. You just are. There'll be a setback. There'll be renegotiations of leases. Don't kid yourself. Most companies right now know what's going on. And if you're a business owner and if you're a corporation, guess what? Guess what you're doing? You're renegotiating leases right now. And some people would say, well, Joe, why would they do that? That's kind of brutal, isn't it? Well, it is. But you know what? When you have to report to a board of directors and investors, you have to look what's best for the bottom line. And a lot of these companies right now are looking at their real estate holdings and their real estate leaseholds, and they're taking a long-term view on what and how this could affect their holdings when it comes to real estate. So I guarantee you right now what's happening, and it hasn't had a tremendous effect, but it will in the next 12 to 18 months. You have millions and millions of square foot being renegotiated right now. Even if they're in the middle of a lease, they're being renegotiated. And why? Because they can. Guess what? It's brutal, but here's what a company does. A company comes to the leasing company or whoever they're working with, and regardless of if they have a contract or not, what do they say? They say, I want to get out of this contract. And the leasing hold company might say, well, that's great, but you have a $200,000 penalty for getting out of this contract. And the company's rebuttal is, well, great, because you know what? That $200,000 is a lot cheaper than me committing to this 200,000 square feet of space over the next 10 years. So I might just bite the bullet and pay the $200,000 fine and walk. Now, that's just one example. I'm not saying that's happening all over, but I can guarantee you these are being looked at, and they're being looked at by companies all over the place. This is going to have an effect on commercial real estate. It just is. So for 2021, I think it's much of the same. I really do. As people come, who knows with the vaccine, most people think that sometime in summer of 2021, we could get back to somewhat normal, maybe not 100%, but some semblance of normalcy by the summer of 2021. That's most people's guess. I think real estate will stay strong in 2021. I believe, I really do. I still think you could see anywhere from 5, 10, 15% appreciation in these homes between now and next year, this time next year. I really do. I think there is. There's still a shortage of inventory. There's a demand for housing, especially suburban, especially homes with property and homes with some space. Those are going to become even more valuable. I do think, just like 2020, I do think condos are still going to struggle. I'm seeing condominiums in San Jose and San Francisco and some of the outlying areas. The pricing's coming down and they're less desirable. And part of the reason, again, is because of the saturation. People don't want to be, in dense areas. the elevators, the idea of being around a lot of people. And here's the other piece, ladies and gentlemen. I mean, HOAs, homeowners association, for those who aren't familiar with it, are ridiculous in the Bay Area. This is another reason people are staying away from condominiums. We just looked at a person, we just had a client that was buying a condominium and put an offer in South San Francisco. Listen to this. For $640,000, I think, $640,000, $650,000, I think it's a 1-bedroom or 2-bedroom, 1-bath condo in South San Francisco. $650,000, let's just call it $650,000 or something like that. Guess what the HOA was? $640 a month. That's ridiculous. That is ridiculous. There are some HOAs that are $1,000, $1,200, $1,300 a month in San Francisco. That's ridiculous. This is another reason why condos are going to become less desirable. People are looking at these HOAs going, wait a minute. First, I'm stacked on top of one another. I'm within 300 or 400 or 500 units. We don't like this congestion right now. Secondly, the cost of these HOAs are skyrocketing. It's ridiculous. And most HOAs can't justify those costs. It's just that they've always charged them and people have always paid them. And when you have a strong market, you don't worry about it so much. But if the markets turn back, then you start getting concerned. So I do think that in the 2021, you're going to see condos, especially condos in downtown dense areas. Now, if we're talking about condos by a beach or condos in a resort area or second, that's different. It's totally different. I would not use them as the equation. But if we're talking about condominiums and high rises and apartments in downtown high density areas, business locations, I think those are going to suffer. I think those are going to have some setbacks. And I also think that 2021, commercial real estate will start feeling the effects in 2021. It was too early for them to feel the effects in 2020 because all this is really taking place right now. Over the last 6 to 12 months, you've had, renegotiations, setbacks, adjustments, leases being redone, buyouts, all kinds. So that's going to take time for that to kind of unfold and unwind itself and show up in the numbers and the data. I believe that in somewhere by the end of the first quarter into the second quarter of 2021, you're going to see some pretty stark numbers when it comes to some specific areas to do with commercial real estate. I think it's going to suffer for a while. A lot of this building that was already taking place is another reason why it's going to suffer for a while. When you have inventory that was being built and hadn't been committed to, and now that's come to a stop and people have slowed down the building of commercial, there's costs associated with that as well. So suggestions I would make for those listening to this podcast for 2021. If you have an opportunity to invest in commercial or real estate in general, do it. And I don't want to leave commercial out either. There're going to be deals no matter what. So I'm not negative on commercial. I'm just advising that you should be careful on the short term because there could be some downturns definitely in commercial, in certain condos in certain areas. But real estate, I'm very bullish on. I think that if you have an opportunity to buy and hold, especially now with money at all-time lows. Another thing I would suggest, people know that listen to the show, we have a team of people, we do mortgages with a team of people here. If you have not taken advantage of the all-time low interest rates, do it and do it as soon as you can. I think rates will stay low for a while, but anytime you're talking about 30-year money under 3%, that's right, under 3%. And by the way, that's jumbo financing as well. So whether you have a loan for $300,000 or $3 million, you could get a 30-year fixed less than 3%. That is an all-time low cost of money. So I would encourage you to take advantage of that, get your savings, lock in low rates for long term. It'll help that investment, that appreciating asset. Also, if you're worried about going backwards, there's programs you can make adjustments to. For instance, if you got into a 30-year fixed 5 years ago and you said, Joe, I really want to take advantage of this, but I don't want to go backwards. That's fine. Most people won't tell you this. You could do a 25-year fixed loan. You could do a 20-year fixed loan. You could do a 15. You could do a 10. You don't have to go backwards. You can refinance and go back to a 27, a 25, a 20, 21. You can pick your year. A lot of people don't know this. You don't have to go backwards and start over again. So be careful of that. Take advantage of the rates. Make sure you do that. And I would also say that any kind of reinvestment you could do in your property, like adding an ADU, an accessory dwelling unit, if you could add more units or more space on your properties, they become more valuable, especially if that space is now permitted. You could add it to your square footage. And if you're talking about some of the areas here in the Bay Area, listen, it's not uncommon to see some of these $1,000 a square foot that are going for $1,000 a square foot. So if you add another 400 or 500 square foot to your property, or put an ADU in the back, in one of these in-law units or those types of things, those are good investments right now. And by the way, cities and counties are advocating to put those in. So that's another good thing. All right, as we wrap things up, again, I want to thank all those that follow the show, that participate in the show, the guests. I apologize for having a limited amount of podcasts this year. It's been a tough year for a lot of people. We've had to refocus on some things. We'll be back with more guests, more experts next year. But in the meantime, real estate will stay strong, and there's a lot of opportunities out there. There always is. I would encourage you, make sure you're working with the right real estate agent and lender when you do make these decisions. It does make a difference when working with the right team. For more information, you can always go to RERL-1747-End. You can contact me either by text or call at 408-838-9060. Thanks again for tuning in. I wish everyone that's listening to this podcast and viewing the podcast a wonderful, healthy wrap-up of 2020 and a wonderful, successful, healthy 2021 ahead. Take care, and we'll be back with you next year.
You've been listening to Real Estate Radio Live. For more information on today's program, visit RERadiolive.com. That's RERadiolive.com. Subscribe to our podcast. Discover more at RERadiolive.com.